What we know is ever since the inception of the EM index, every time we've had a structural decline in the US dollar, a US dollar bear market, the EM index has strongly outperformed every other asset class. And so the last example was that period from about 2003 all the way through to 2008, where EM equities rallied more than 230%. We know that on pretty much every metric, the US dollars are significantly overvalued. Purchasing power parity, interest rate parity, if you look at the Dixie index, also the length of cycle. So US dollar floated with the Nixon shock in the early 70s, and it's moved in broad 8 to 10 year cycles since then. We're very, very late US dollar bull market. So it's a question of when, not if, and at some point the US dollar is going to move into a structural declining phase, which is exactly what's happened over the last 50 years, and that will be a catalyst for strong relative outperformance of emerging market equities. Yes, I think the biggest misconception is that EM equals China. And that's just not the way to think about this asset class. First, EM is 2/3 of the global population, half of global GDP. So it's a vast asset class. In the index, 25 countries. Now, China is actually the odd one out in the index. It's not really an emerging market. If we think of what are the things that define when we think of emerging markets, good demographics, relatively low debt levels, good structural growth, tailwinds for urbanization, healthcare, and so on. China has none of these. China's fertility rate is actually below Japan's. So China is one of the fastest aging economies in the world. It has extremely high debt levels. Not just, people say, well, it's all government debt. Well, certainly aggregate debt to GDP is 300%. But let's not forget that the Chinese consumer debt to disposable income is the same as the US, but at a much lower level of GDP per capita. So when you think about, as your GDP per capita rises, you can hold more debt. So actually the Chinese consumer is more indebted than the US consumer. So it's the odd one out. It's not where the most attractive opportunities are in emerging markets. And that's the misconception. Really, you want to have a selective approach. This is an asset class where you absolutely don't want to go passive, because you buy the index, 30% of that is China, which isn't really an emerging market. You need a selective manager who's going to focus on those real attractive structural growth areas and most likely be very underweight China. So it's still Mexico's time in the sun. They are the biggest beneficiary of the structural deterioration in US-China relations. Friendshoring, nearshoring, that's real. Mexico, that relationship is strong, and Mexico is just absolutely blessed. It has excellent infrastructure links with the US, wage rates that are 20% of the US. Intellectual property is protected. That was always a complaint with supply chains in China. With Mexico, intellectual property is protected, enshrined by NAFTA. Same time zone, very, very well placed as the global supply chain rebalances away from China. Specifically on the stock side, we think that FEMSA is mispriced still. Now that's been a very strong performer, but within FEMSA is arguably the best retailer in emerging markets, certainly the best convenience store retailer in emerging markets, OXXO. And if you back out, FEMSA also has a stake in a big listed company. It's a conglomerate, so there's a bit of a conglomerate discount. The company is going to address that, we think, and focus on that jewel in the crown, which is OXXO. If you back out OXXO's current valuation, it's trading on 8 times EV/EBITDA. It's dirt cheap. This is for a business that's opening 5 new convenience stores across Latin America every day. 5 new stores every day. 3 in Mexico, 1 in the rest of Latin America, ex-Brazil, and another one in Brazil. Now, they're already at 23,000 odd stores in Mexico, but still growing 3 stores a day, so still adding 1,000 stores a year. The real opportunity is Brazil. So Brazil's significantly larger population than Mexico. There is no modern convenience store chain there of any scale, so it's green space for OXXO. OXXO's got a proven model. They've been operating in Mexico for more than 30 years. They're going to roll out the same model in Brazil, and we're seeing the early signs of significant success there. So Brazil could easily be 30,000 stores in the long run. That's just not priced in. Excellent operators. I visited their operations in Monterrey in Mexico a couple of months ago. really, really focused on driving efficiencies, absolutely getting the most productivity out of the stores. And the dynamic you have in Mexico, which is what they're seeking to replicate in Brazil, they're the number one player in modern convenience with 23,000 stores. Number two player is 7-Eleven with about 1,000 stores. So they're 20 times bigger than the second player. Short-term volatility is here to stay. There will be global geopolitical black swans. When Russia invaded Ukraine, very few experts had that in their forecast, even 3 months out. So by definition, I can't tell you what the geopolitical shocks are going to be next year. But the key is having a long-term focus, buying companies that are resilient. You want to own companies, and certainly this is our portfolio, which are net cash. If you have significant borrowings and there's an external shock, price of refinancing that debt goes up, and often you end up selling your prized assets. So they're at the absolute bottom of the market. Resilient companies in resilient countries. So again, countries that are driven by primarily domestic demand rather than exposed to global trade. I think though that subset will outperform. And I think people complain about volatility, but if you're an active manager, a selective manager, volatility is your friend because it keeps throwing up opportunities. You see really good companies sold off. The market, when there's an external shock, gets very bad at distinguishing between the high quality companies and the weak quality companies. And so there's your opportunity to buy the best companies. And in the end, the earnings growth is what's going to drive the share price. And so that's why you want to buy the resilient companies, because the earnings growth, as soon as they report, share price recovers, but there'll be opportunities in volatility where the market is indiscriminate.